dollar is still positive. Stocks have lost a little bit of their bounce. Rates trying to pick a direction. It's an interesting response to a very interesting number from the employment situation this morning. Let's talk with Rebecca Walser, President of Walser Wealth Management. Rebecca, welcome back. Happy New Year. Good to have you here.
Happy New Year, Oliver. Thank you.
Absolutely. You've given us a message of caution that it was very correct and helpful for stocks the past year. Does any of that change as we look at the employment situation right now?
I mean, obviously, it's good. Anytime we beat expectation and we have a positive uptick of jobs, awesome, really good news. And we love that. And that means the Fed, can continue its mission to achieve the almost impossible soft landing, especially these global macroeconomic factors. So I still see a lot of caution. It's not so much, we're just not isolated, Oliver. We're not just U.S. domestic, right? It's a global situation that we're dealing with. And so obviously that has an impact. So I still see a lot of cautions in this Q1, but I love any good news, and every win is a celebration.
All right. Now, right now, the market that's been winning the most is Chinese stocks. The last couple of weeks, they've had a face-ripping rally. So when you talk about playing the international front, that's what I think about right now. Across the pond in Europe, they've got some major inflation issues, bigger than ours right now, arguably. Yeah. So if you look outside the U.S., what are our options?
So, yeah, I agree with you. I mean, Europe is seeing it come from 10 down to the 9 range. So they're seeing a little bit of impact. But, they were a lot slower, Oliver, to, go for interest rate increases. We saw that a very slow, even Bank of Japan, obviously I'm going over Asia now, Bank of Japan, obviously not even doing, the only central bank of all of 2020 that did not do any rate hikes. So Europe is seeing a little bit of a downtick in inflation. I think that we're going to see probably, because we're still 2 months left of winter, and the energy crisis with Europe and the pipelines and all those things still have yet to have that impact. So I'm still bracing from that perspective to see kind of how that works out. But as far as China, I think, the market braced for these really, archaic maybe lockdowns from coronavirus, because obviously they have something going on over there. And I think when they eased restrictions, that the market said, oh, well, you know what, maybe there's some hope. And I think we're getting a reaction to, okay, we might still have some hope that we could have some sort of a normal start to the year without these crazy zero COVID policy restrictions. So I think that there is really positive news everywhere, but nothing is actually fundamentally resolved, Oliver, and that's the problem.
So here, and our inflation situation improving as the numbers have come down, but still elevated, and a Fed that looks pretty set to keep fighting inflation. And from the messaging in minutes this week, that they also don't want to see financial conditions loosen too much through stocks. So has anything really changed in terms of how investors should think about the regime that's been created by the Fed? Growth stocks going down, value stocks doing a little bit better, but still going down too?
Yeah, I mean, I think the problem with the value stocks is obviously we look at value stocks for dividends usually and cash flow, right? And if the underlying stock value comes down, you have a longer term investor who's not so worried about the capital gain side of it, because they're really looking for the yield on the value side. The problem with the value stocks is the dividends will look to be cut when the cost of capital is too expensive. In other words, if we can cut our dividends and use our own cash instead of going out into the market as the cost of capital continues to go up because of federal, Federal Reserve interest rate hikes, that's when you start to see the value stocks start to make different, calculations on dividend policy. And so I caution investors to say and to believe going into 2023 that they can just move to value and rely on cash flow, because that too can change if our economic conditions really worsen, and companies will make that decision. But for now, obviously, the winner of the day would be someone where you don't worry about the underlying price fluctuation of the stock, and you're really looking for yield and cash flow. So I can see that makes a lot of sense, but I would still just have caution, because the Federal Reserve likely will give us another 50 basis points, I believe, at the end of January. I don't think the job report alone, now obviously we'll get CPI data next week and we'll find out. And I think though, Oliver, it only re-emphasizes and only re-encourages the Federal Reserve when they do see their actions working to continue on that course.
Okay, that's kind of exactly what I was thinking this morning, which was if I'm Jay Powell and I'm looking at this, I'm kind of going, all right, not bad.
Exactly.
Participation rate going up, unemployment down, a few cracks and some issues in the high-tech stuff, but maybe a price that I have to pay to cool down the bubble from the last couple of years. So I guess they can look at this and think jobs going all right.
Yeah, I mean, I think right now, I still have a big concern about where all the workers. We still have almost 10.5 million job openings, but it is great to see a really strong job report at the beginning of end of the year, obviously coming out this year. And every win we'll take, Oliver. We'll take, the 2022 was so difficult that any kind of good news we want to hold on to and celebrate, like, yay. But at the same time, this is, we have not turned the corner. We still have the Fed in a rock and a hard place. They have to keep the strength of the dollar up globally because of the monetary macroeconomic changes that are happening with the BRICS nations, the gold reserve currencies coming on board. This is a lot of macroeconomic changes that Powell needs to keep that dollar strong. So I really think that it's going to take a lot more to make him go from hawkish to something else.
Rebecca, looking at your notes and a few other items that are on your mind, I want to get your thoughts on real fast. Some of the residual damage from the last year that seems to be now kind of almost independent of the month-to-month decisions on interest rates, Bed Bath & Beyond talking bankruptcy, the FTX impact on crypto where Silvergate dropped 40% yesterday. Are we still going to see some carnage in the softest areas that was exposed over the last year?
We are. There's no doubt. That's what I say. The fundamentals are just still not secure. And so until we get to that level, until we can really see, positive GDP, great earnings, lower cost of capital, much more R&D happening again, which obviously is the opposite of the direction that we are in right now, expansion, not contraction. We are a consumer-based economy. So as the economy has less consumerism and more contraction, we won't see the fundamentals turn around. And the cost of capital is really the biggest hurdle that we have right now, because we have been used to since 2008 almost such a low cost of capital for businesses that it was cheaper for them to borrow than to use their own cash flow, and that is not the case anymore potentially. So we still need the fundamentals, but there's just so much still wrong. Obviously the crypto situation, I think we'll have a lot more to come on that. And Bed Bath & Beyond, that is just a whole mix of retail versus online versus brick and mortar. It's just, and then it's a novelty, not a novelty, but it's not like a utility shop. It's not like we have to go there and we have to buy groceries every week. So we have that consumerism tied to living. It is more of a discretionary. So they're just really struggling every way to Sunday, and it's sad because they've done so much restructuring over the last couple of years, and it's still just not gotten their solid footing on the ground. So we expect that to not go well.
All right. Thanks for the commentary, Rebecca, as always. Looking forward to continuing the conversation this year.
Thank you, Oliver.
Have a good one. Rebecca Walser, President at Walser Wealth Management.